My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. Call me at 1-800-743-CNBC. Tweet me at Jim Cramer. If you come out here to talk about stocks every night, then you better believe you're going to make some mistakes in a highly visible, highly public way. And by you, of course, I mean me. That's why every year I like to hold a day of atonement to help you learn from my worst mistakes. So tonight I'm going to demonstrate how we can all improve by examining a number of calls we've made on Mad Money and the Charitable Trust, explaining why they occurred, what went wrong, and what you can do to learn from me and do it better. Before I get into specifics, though, let me give you a sense of what I see as the biggest kinds of errors I seem to have made and how I will vow once again to try not to make them, even as different ones then pop up to haunt me. Most of the things I do wrong these days after 40-plus years in the business aren't rookie mistakes. It's very rare now that I suggest a quick trade that then goes awry, because anyone who has watched the show morph over the years knows that I have moved away speedily against trading and spend most of my time trying to cajole you into investing. I've come to dislike the suggestion of day trading or even quick trading or even options, because I think it's going to hurt your chance of making money. It's just wrong to trade unless you're doing a full-time job, and even then I wouldn't recommend it. My mistakes rarely have to do with not doing enough homework. These days I'm doing, I think, more and better homework than I did back in my hedge fund, with a terrific staff of savvy people who've now been with me for some time and are really fabulous. Great team of the CNBC Investing Club, too. If anything, I am crushing it and being crushed by my homework, as there are hundreds more public companies now than when I started. No, if anything, it's the opposite of rookie mistakes that I'm making. Why don't we call them veterans' mistakes? My errors are rooted in overconfidence and arrogance of judgment and in too much belief in what's worked so well before that it has to work again. They're blunders I make because I sometimes feel like I've seen the movie before and I know how it ends, when the great challenge of investing in the stock market means that in reality, it's much more like a close sporting event where you don't know the outcome of what it'll be, and just when you're sure you do, that's when you get the big upset. The worst errors I've made, though, have to do with trust, either by being too trusting or not trusting enough. I've trusted too many executives with good track records who told me not to worry about things that ultimately needed to be worried about. These are usually people with a lot of credibility, but one of the perils of success is that eventually you can start believing your own BS. At the same time, there are other executives I didn't trust who perhaps upon closer review actually deserved a little more credit. Most of all, though, I do this night of self-criticism, and I do it all the time. I do it to remind me and to remind you that while I come out here daily to try to get it right, I'm only human, and I fall prey to all the misjudgments that anyone else might fall prey to. But we've got to learn from them nonetheless. So why don't we do this? Let me start with a story that really that gets me down and let you down. It's a story where I had too much faith in management's power to triumph over an objectively difficult situation. I'm talking about the tale of Johnson & Johnson. Long one of my favorite companies, which we used to own for the Charitable Trust, until we finally threw in the towel and gave up the position, promptly, though, in the summer of 2023. Normally, when we sell a stock for the trust, it's because something's changed at the company or in the industry, or the stock hits our price target, and we don't want to be greedy. We set price targets if you subscribe to members of the club. See, we care about chasing profits, but as we teach members of the club, which chronicles the moves of the trust and details any trades before the trust makes them, we care far more about containing losses, because when you control your losses, well, guess what? The gains take care of themselves. But we didn't sell J&J because of the fundamentals. I still believe J&J has one of the best pharma pipelines in the industry, along with a terrific medical device portfolio. No, we gave up on J&J at a small gain, mind you, because we were tired of being hostage to legal decisions that had little to do with the greatness of this storied company. Specifically, J&J was neck deep in lawsuits involving its baby powder, and whether its one-time key ingredient talc had traces of asbestos in it, traces that might have caused people to get cancer. 20 years ago, I would have known instantly that asbestos lawsuits equal sell. But it has been so long since we had one of these that I forgot how ugly they could get for shareholders. I forgot that asbestos is a magnet for plaintiffs' lawyers. I believe that J&J's lawyers had control of the situation because they seemed persuasive and had good resumes. But you could have said the same thing about all the defense lawyers who lost big asbestos cases in the 1980s. When these talc lawsuits first exploded, I said, I know how to deal with this. I brought on the CEO, Alex Gorski, on the show. And after a considerable amount of research, I came to the conclusion that J&J acted in good faith. At the very least, they didn't know about the asbestos. In fact, I was convinced there might not have been any asbestos in it to begin with. The whole thing seemed like an accident at worst. That was a misjudgment. Since then, there have been a seemingly endless number of cases filed against J&J. And while it's won many of them, it's also lost some big ones, including a $2 billion judgment that made me, let's say, believe I simply wasn't taking the plaintiff's side seriously enough. Again, 20 years ago, I never would have bet on a company engaged in asbestos-related litigation, because that's a great way to light your money on fire. I forgot how tough these lawsuits were. I forgot how the great companies that went under because of asbestos, even as many of it I didn't think deserved it, but deserves, of course, got nothing to do with it. Then J&J came up with what I thought was an excellent strategy: pay $8.9 billion to the plaintiffs as part of a global settlement that would have put this whole thing behind them, and more important, put immediate money into the hands of the claimants. Good for everyone, and many plaintiffs' lawyers agreed. I started feeling hopeful. Another mistake. The Third Circuit Court in Philadelphia, I found out later, absolutely hates these kinds of agreements, these bad settlements. That's what they think. How could I not see that coming? Because J&J's lawyers were so optimistic, and I was a fool to believe them. In the meantime, J&J reported terrific quarter and spun off its consumer products division as Kenvue in a hugely successful IPO. But really, when the charitable trust owned J&J, we thought we were betting on the fundamentals of the company. But you know what? We were actually betting on the thing that controlled the stock, and that was the litigation. And you never want to play that game. It is a game. In retrospect, I was far too sanguine about J&J's ability to get a settlement that would protect their shareholders from unlimited losses through a novel use of the bankruptcy code. Eventually, the judge overseeing the faux bankruptcy sided with the plaintiffs against J&J. So the company once again found itself at the mercy of the lawyers bringing suits for the extremely sympathetic clients. The court ruled that J&J was not in true financial distress, so it didn't have a right to the bankruptcy course. That's when I knew these cases would mount up, leading to another procession of hard-to-predict verdicts. Hence why we finally gave up on J&J for the charitable trust. See, it didn't matter that I thought they weren't particularly culpable. It didn't matter that the underlying fundamentals were terrific. What matters is that through this litigation, they were potentially on the hook for billions of dollars, almost incalculable, in losses. In the end, you simply don't want to have a position that's precarious because of lawsuits, not because of the fundamentals. Hey, this business is hard enough without playing litigation roulette via jackpot justice system that we have in this country. I don't want to wake up one day and discover that some runaway jury decided J&J's earnings belong not to the stockholders, but to the sick claimants. I've seen this happen several times in situations that were truly pernicious, where the companies absolutely had it coming. I don't think J&J is one of them. They had a tremendous balance sheet, too. But so what? It doesn't matter what I think. It matters what the juries think. And you don't bet on friendly juries when you're looking at an asbestos suit in a big, rich company. In fact, the terrific balance sheet actually worked against J&J. What well-endowed company should be allowed to file for bankruptcy? So I didn't think the ultimate upside was worth hoping for. Hope should never be part of the equation, of course. Given the nature of our legal system, there's really no telling how bad this one could be, which is why we had the charitable trust dump this great American company. Bottom line, I like betting on businesses, not lawsuits and lawyers who game them. So if you ever find yourself betting on a brutal set of lawsuits, don't try to fight it just because you love the company, like I did with J&J for so long. Believe me, there are better and easier ways to try to make some money. Let's go to Eric in Florida. Eric.
My call.
Oh, of course, Eric. What's up?
So my question, so you advise investors or home gamers take their first $10,000 and stick that in a low-cost index fund.
Yes, I do.
My question for you is, as us home gamers build wealth over time, the weighting of that initial $10,000 from an overall portfolio perspective, if you're doing it right, becomes less significant. What do you recommend home gamers maintain as a weighting in terms of that position? And would you also maybe advise adding Qs or IWM?
What a great question. And I've got to tell you, yes, indeed. I actually think more about the smaller investor than I think about the larger one. But if you save over time, what you want to do is probably ultimately get it so that about 50% of your portfolio at minimum is the index fund. And then you can have some other stocks and maybe mix in some bonds as you get older. But I do believe that the index fund is the bedrock. And thank you for recognizing that's my feeling. Let's go to Sean in Massachusetts. Sean.
Hey, Mr. Cramer, thank you so much for taking my call to you and your team, and thanks to the ladies that got me checked in. Excellent. I hear you talk a lot about S&P 500 or something similar, too. My question to you is, should I change my current investments in my 401k plan through my employer to the Vanguard Index 500 at 100%, which my company offers, or should I split it up with the current investments that I currently have in the plan?
Look, I am very conservative, and to me, you want to be diversified, and that means index fund best. But it sounds like you're doing it very right. I am, again, incredibly conservative when it comes to retirement money. If you ever find yourself betting on a brutal set of lawsuits, please do not try to fight it just because you love the company like I did with J&J so long. You must believe me when I say there are better ways to try to make money. On Mad Money tonight, from Silicon Valley Bank to Boeing, I'm sharing the pain that I've experienced in the years that I've been around, and I've got to tell you something.
The House of Pain.
The best strategy on how to handle it is what you're going to learn tonight. Don't fret. You and I will get through this together. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.